Imagine waking up one morning and checking your investment account and realizing that while you were sleeping, your money made more money than you did that entire day. Not because you got lucky, not because you picked the perfect stock, but because of a quiet, almost boring system that started with just $10 a day. Now most people hear that and immediately think one of two things. Either that's too small to matter, or if investing was that easy, everyone would already be rich. And that's exactly why this strategy works. Because the biggest obstacle in investing isn't intelligence, it isn't access, and it definitely isn't money. The biggest obstacle is how the human brain understands time. This is a channel where we break down the hidden mechanics of money so you can make smarter financial decisions. Not just what to do with money, but why money behaves the way it does. Most people believe investing starts when you finally have real money. When you get the promotion, when you save your first $10,000, when you feel like you're financially stable. Until then, people think investing small amounts is pointless. The biggest obstacle is how the human brain understands time. This is a channel where we break down the hidden mechanics of money so you can make smarter financial decisions. Most people believe investing starts when you finally have real money. When you get the promotion, when you save your first $10,000, when you feel like you're financially stable. $10. That's lunch money, coffee money, streaming subscription money. How could something that small possibly matter in the world of investing? So instead of investing small amounts consistently, people wait. They wait until they have more. They wait until they understand the market. They wait until the timing feels right. But here's the problem. While they're waiting, time keeps moving. And in investing, time is not just helpful. Time is the entire engine. Let's break this down in a way most people never think about. Imagine two people. Person A starts investing $10 a day. That's $300 a month. Not huge, not life-changing, but they start at age 25. They invest that money into a broad market index fund, averaging about 8% per year. Now imagine person B. They're more successful, higher income, better job, but they wait until age 35 to start investing. When they finally begin, they invest $500 a month. More money than person A, more aggressive, more serious. But here's where the math gets strange. By age 55, person A, investing $10 a day, ends up with roughly $447,000. Person B, investing $500 a month, ends up with around $379,000. Even though person B invested more money per month, the difference, 10 years, just 10 years of time. This is where things get interesting, because when people think about investing, they focus on the size of the contribution. But the market mostly cares about how long the money stays invested. And that's the secret behind the $10 strategy. It's not about the amount. It's about building the time machine as early as possible. Now, here's the part most people miss. The reason small investing feels pointless has nothing to do with math. It has everything to do with human psychology. Our brains evolved to survive in environments where results were immediate. You hunt, you gather, you eat. Effort leads to quick outcomes, but investing operates on a completely different timeline. For the first few years, nothing exciting happens. You invest $10 today. Tomorrow, your account might move 50 cents. Next week, it drops $1. After a year, you check the balance and think, that's it. And that's when most people quit, because the brain interprets slow progress as failure. But in reality, investing follows something called exponential growth. And exponential growth is invisible until suddenly it isn't. For years, progress looks flat. Then slowly it bends upward. Then eventually it explodes. The early phase feels pointless, but it's actually the most important phase of the entire process. Because you're not just investing money, you're investing time. Let's zoom in on the math. If you invest $10 per day, that's about $3,650 per year. Now assume a long-term average market return of about 8% annually. After 10 years, you'd have roughly $52,000. Not bad, but not life-changing either. And this is exactly the moment where most people underestimate what's happening. Because from this point forward, the market starts doing more of the work than you do. After 20 years, that $10 per day becomes about $167,000. After 30 years, about $447,000. And here's where the curve becomes fascinating. In the first decade, your investments grow by about $15,000 beyond your contributions. But in the third decade, the growth adds more than $200,000 without increasing the daily amount, without picking better stocks, without timing the market, just because the money had time to compound. And this is why starting small beats starting late, because compounding behaves like a snowball rolling down a mountain. At first, it's small, almost disappointing, but once it gathers enough snow, it becomes unstoppable. So what does the actual $10 per day strategy look like in practice? It's surprisingly simple, but simplicity is exactly what makes it powerful. Step 1 is automation. Instead of relying on motivation, you create a system. Set up an automatic transfer of around $300 per month from your checking account into an investment account. Automation removes the single biggest reason people fail at investing: inconsistency. You're no longer deciding every month whether to invest. The system decides for you. Step 2 is simplicity. Most beginners get trapped in stock picking. They spend hours researching companies, analyzing charts, and chasing hot trends. But the data consistently shows something uncomfortable. Over long periods of time, most professional investors fail to beat the market. So the strategy here is straightforward. Invest in low-cost index funds that track the overall market. This gives you instant diversification across hundreds or thousands of companies. You're not betting on a single winner. You're investing in the growth of the entire economy. Step 3 is consistency during chaos. Markets will crash. Headlines will scream panic. Social media will predict financial collapse. And during those moments, the most powerful move is often the simplest one. You keep investing, the same $10 per day, because market downturns are not interruptions to the strategy. They are part of the strategy. Lower prices mean your daily investment buys more shares, which means when the market recovers, your compounding accelerates. But there's a hidden trap inside this strategy, and it has nothing to do with the market. It has everything to do with lifestyle inflation. As income increases, expenses tend to rise automatically. Better apartment, nicer car, more subscriptions, more convenience. And slowly, the idea of investing $10 per day begins to feel unnecessary. People think, I'll start investing seriously later. But the irony is this: the moment your income rises is the easiest time to scale the strategy. $10 a day can quietly become 15, then 20, then 50, without dramatically changing your lifestyle. And if that happens, the numbers change dramatically. $20 per day invested over 30 years becomes roughly $900,000. $50 per day becomes over $2 million. Not through luck, not through speculation, but through disciplined consistency. Now let's look forward, because the investing world is changing rapidly. In the past, investing required large minimum balances, broker fees, and complicated processes. Today, technology has eliminated most of those barriers. Fractional shares allow you to invest with small amounts. Automated investing platforms handle allocation. Transaction costs have dropped close to zero, which means strategies like the $10 per day system are more accessible than ever. But this accessibility also introduces a new danger: overtrading. When investing becomes as easy as scrolling social media, people start treating it like entertainment, buying and selling constantly, chasing trends, trying to beat algorithms. But historically, the investors who win are rarely the most active. They're the most patient. The future will reward investors who combine automation with discipline, not excitement. So let's simplify the entire strategy. Step 1. Start immediately, even if the amount feels small. Step 2. Automate the daily investment so consistency becomes effortless. Step 3. Invest in broad, low-cost index funds instead of chasing individual stocks. Step 4. Continue investing during market downturns instead of panicking. Step 5. Gradually increase the daily amount as your income grows. Follow these steps long enough, and the math of compounding begins to work quietly in your favor. Most people believe wealth comes from dramatic decisions, big investments, perfect timing, brilliant market predictions. But in reality, financial independence is usually built through something much less exciting. Small decisions repeated thousands of times. $10 today, $10 tomorrow, $10 the next day. Until one day, decades later, you look back and realize something surprising. The most powerful investment you ever made was simply starting earlier than everyone else.